Aluminum is the world's most widely used non-ferrous metal, prized for its low density, corrosion resistance, and recyclability. Over the next 5 minutes, we'll examine its vast supply, diverse demand drivers, recent price dynamics, and strategic approaches for institutional and retail investors. Total cumulative above-ground aluminum stock exceeds 1.5 billion metric tons, more than any other metal except iron. Annual primary production reached a record 73 million tons in 2024, concentrated in China, 59% of global output, producing those 43 million tons. India, 6% with 4.2 million tons. Russia, 5% at 3.8 million tons. Canada, 4% at 3.3 million tons. United Arab Emirates, 4% at 2.7 million tons. Despite abundant bauxite reserves, aluminum smelting is highly energy intensive, requiring 14 to 16 MWh per ton. Over 60% of smelter power still comes from fossil fuels, driving regional cost differences and carbon intensity variations. Secondary, recycled aluminum supplies roughly 36% of total production, consuming only 5% of the energy required for primary smelting and underpinning the metal's circular economy role. Aluminum's combination of lightweight, strength, and corrosion resistance makes it indispensable across end-use sectors. In 2023, global consumption by sector was approximately transportation, 37%, vehicle bodies, aircraft structures, and EV battery enclosures. Each electric vehicle uses 60-80 kilos more aluminum than internal combustion models. Packaging, 19%, beverage cans, foils, and closures, driven by plastic substitution trends and sustainability preferences. Construction, 15%, window frames, curtain walls, roofing, and structural components. Urbanization and energy-efficient building codes support steady growth. Electrical, 7%, power transmission lines, conductors, and heat exchangers. Aluminum's conductivity and weight advantages over copper fuel demand in grids and EV charging networks. Machinery and equipment, 9%. Industrial equipment, tooling, and consumer appliances require corrosion-resistant lightweight components. Consumer durables and other, 13%. Electronics, sports equipment, and packaging for food and beverage products. Automotive lightweighting alone is expected to boost transportation demand by 30% through 2025 to an estimated 31.7 million tons by 2030 as EV penetration surges. LME primary aluminum traded near USD 2,617 ton in October 2024, supported by energy price shocks. Higher natural gas and coal prices in Europe and Asia raised smelting costs, constraining output. Alumina supply tightness, disruptions in bauxite exports from Guinea, and rising alumina prices from USD 350 to USD 700 per ton pressured margins. Carbon cost impact. EU carbon prices above 80 TCO2 elevated European smelter break-evens, reducing exportable volumes. Chinese policy shifts. Production curbs for environmental targets and export duties on hot-rolled coil tightened physical availability. Inventory fluctuations. LME stocks hovered near 5-year lows in mid-2025, limiting buffer against demand spikes. Institutional investors use aluminum futures and options on LME and SHFE for directional and hedged exposures. Invest in midstream assets, smelters, rolling mills, and alumina refineries to capture integrated margin. Allocate via commodity index funds with modest 1-3% weightings, balancing industrial cycle and inflation hedge properties. Retail investors access LME-backed aluminum ETFs, e.g. ALAM or leveraged products for shorter-term trading. Face roll yield drag in spot roll ETFs and wider bid-ask spreads than precious metals products. Can invest in aluminum-intensive equities, Alcoa, Shalco, Norsk Hydro, for equity-style exposure to metal and margin trends. For retail investors, a strategic 3-5% aluminum allocation can diversify away from traditional commodities. Seasonal patterns, higher construction demand in spring-summer, offer tactical trading windows. Be mindful of roll costs and storage fees in physical or ETF structures. equities may offer lower operational drag. For professional managers, integrated supply chain plays, bauxite, alumina, smelting, rolling provide value capture across the cycle. ESG-driven green aluminum premiums produced with hydro or renewable power can yield margin overlays and meet sustainability mandates. Infrastructure funds target renewable energy-powered smelters and recycling facilities for yield and carbon alignment. Key investment reminders. Energy cost sensitivity. Smelting margins swing dramatically with power price differentials. Regional dynamics matter. Carbon regulations. Scope 1 and 2 emissions, 10 TCO2 ETT, and tightening net zero targets will reshape cost curves and competitiveness. Recycling potential. Secondary aluminum's low energy use underpins the circular economy but cannot fully offset primary demand growth. Cyclicality versus secular growth. Construction and auto cycles drive near-term swings, while long-term EV and packaging trends underpin secular demand. Inventory signals. LME and SHFE stocks provide leading indicators of market tightness. Near record lows often precede price rallies. Summary and strategic takeaways. Long-term outlook. Aluminum's critical role in decarbonization, lightweighting, and sustainable packaging supports durable demand growth, even as energy and carbon constraints limit supply responsiveness. Investment thesis. Secular drivers, EV adoption, urbanization, and circular economy mandates converge to tighten markets, while energy price volatility creates tactical opportunities. Portfolio considerations. A diversified mix of futures, equities, infrastructure assets, and recycled metal plays balances return potential with operational and roll costs. Timing strategies. Leverage seasonal demand peaks, monitor energy and carbon price cycles, and capitalize on policy shifts enabling green premium differentials. Aluminum stands at the intersection of industrial necessity and sustainability imperatives. Mastering its supply-demand dynamics and cost structure drivers is key to unlocking its portfolio diversification and tactical trading potential. Thanks for watching. Share your insights below, like, subscribe, and ring the bell for more metals market analysis. See you next time.